My name is Dakotah Hyslop. I hope all is well with you today. Happy Thursday. Hopefully your day is going as well as mine is. I just finished up my 12-week Python coding and data analytics bootcamp from Savvy Coders. Very happy today. I'd like to show you my presentation and do a quick introduction. Today I'm going to be doing a project on Microsoft and Apple with the financial ratio and trend analysis ran on each one. Just a little bit about me real quick. I'm originally from Springfield, Ohio. After I graduated, I joined the Marine Corps, traveled the world, and had a lot of good cultural experiences. After being honorably discharged, I completed my bachelor's of business degree. Currently, I'm working on my MBA in finance, and I'm about to finish up this 12-week Python coding and data analytics bootcamp in about an hour. I started pursuing the Python coding and data analytics bootcamp at Savvy Coders because both of these are very applicable tools for what I would like to be doing in the future as a financial analyst. The science of money has always been a passion of mine, which is what led me to how I chose to do my Capstone project. I'm looking to leverage my technical skills, service, and knowledge for providing innovative solutions to new problems. I chose to make a Python program that collected historical financial data from an API to be used for performing a trend analysis and financial ratio analysis on Apple and Microsoft to demonstrate practical use of previously learned financial knowledge in combination with Python coding. My capstone determines whether Apple or Microsoft would be a better long-term investment by identifying major trends and overall financial health of both companies through financial ratio analysis. Shall we? Starting off, I worked on a team in an agile environment. So I had the privilege of serving as the product owner for the first half of the cohort on Team 2 with Adam Klima as my Scrum Master. The Scrum Master and I acted as one united front, ensuring that if any of our team members on Team 2 had any problems, we set aside the necessary time outside class to help them solve their problems. We started out every day by having the Scrum Master lead the daily stand-up, going over blockers and any other necessary information that needed to be brought to Team 2's attention at the time. As the product owner, my main job was to create the sprints with story points that were made in 4-week segments using Jira software. Within the sprints, I was responsible for creating the necessary parent and child issues to ensure our team had a clear and concise understanding of what, when, and how tasks needed to be completed. Furthermore, if there was a parent issue that wasn't completed within that last sprint, it was then brought forward to the current sprint until it was completed. Down here's a picture of the Jira software that we're using. So as far as technology goes, I used Jupyter Notebooks, a web-based environment used for storing code remotely. And then I also used Microsoft Excel, very famous in finance, used for cleaning, manipulating, and building financial tools used for making sound decisions. Then within Jupyter Notebook, doing Python coding, I imported and used the Pandas library. This was used to manipulate my data in an organized manner, put it in a data frame. Then I used the requests library for making HTTP requests so I could retrieve the data from my API. And then I used the JSON library, used for translating my data from HTML code into text so I could read it and manipulate it. So this is the million-dollar question right here, literally. Based off of a fundamental analysis of Apple and Microsoft, which company would be a better long-term investment using $1 million? So starting off here, we have the liquidity ratios. We have the current and quick ratio for Microsoft going from 2019 to 2022, year over year. So both companies do look like they are in good standing with their liquidity ratios, as they are both within and above the average range for the information technology sector. Microsoft looks like they are more liquid than Apple within a 4-year range. I know within the information technology sector, as long as there is a 1.0 or above, usually they're standing pretty well. Next, I wanted to go over the profitability ratios. So starting off with the gross profit margin, Apple's gross profit margin is not looking great with a 4-year moving average of 0.4. Microsoft exceeds the industry standard by 0.1. This may indicate that Apple needs to increase their efficiency or try and lower the prices from their suppliers, since the industry average is 0.5. Next, we got the net profit margin here. So both Microsoft and Apple are not doing well with their net profit margins, as neither one can meet the industry average. However, Microsoft is exceeding Apple. The industry average is 0.08 or above, as you can see on the right side. Next is going to be the return on assets. So the industry average for this is 0.05. Apple has a slightly better return on assets than Microsoft, but they're still both below industry average. So I wouldn't say they're doing too well there, but other parts of the financial statements can definitely account for what's happening right now. We have to take a deeper look. So next is going to be the return on equity. Now this kind of brings an interesting story about Apple, it seems like. Apple's return on equity has a very steep and positive increase year over year, while Microsoft remains almost stagnant over the last 4 years. Microsoft could increase dividend payments probably to increase this as a solution potentially, is my guess. All right, moving on. We have the efficiency ratios. So for the first one, we're doing the average collection period from 2019 to 2022. The average collection period for the industry standard in IT is 30 to 45 days. Microsoft has a minorly consistent declining average collection period with a moving average that is almost 2 times the industry standard for information technology. Apple looks like it's done a good job at bringing down their moving average to just above 60. They both need to collect their accounts receivable faster, though, in order to increase efficiency through their business. That way they can meet the industry average sector of 30 to 45 days. Next one right here, the average days inventory. This one does look a little pretty low, but is what it is. Average days inventory. So both companies are performing well within both exceeding the industry standard of days it takes to sell their inventory. Apple has almost perfectly and consistently done that, while Microsoft varies between 20 and 17 days, as you can see here. Year over year, both are good, but Apple does better with the average days inventory. Absolutely. I believe that consistency is always better, because then you can make slight tweaks or measurements off of that in order to improve. Next, we have the average days payable ratio. So both Apple and Microsoft take almost 3 times as long to pay their suppliers than the industry average for information technology. Microsoft does have a slightly lower moving average, but not by much. So I wouldn't give this to one or the other. However, with Microsoft being a little bit lower and being in a financially data-driven field, you definitely have to look at every number because they all matter. More with efficiency ratios. So starting off here is actually pretty interesting, and I put these 2 charts beside each other on purpose. So the cash conversion cycle, both companies are doing well, with both companies exceeding the industry standard for the cash conversion cycle. Industry standard for this is going to be 30 to 60. So Apple actually has a negative cash conversion cycle, which looking at a graph like this, you would think that's bad at a first glance, but it's actually not. So it's definitely exceeding Microsoft's positive cash conversion cycle ratio. This is a good situation for Apple to be in because it means that they are selling their products before they're even made, and their vendors are financing their business operations. So people want their products before they even come out. Someone could say that an iPhone comes out a year from now and someone's already trying to pre-order it. So very cool. But the reason I put that right beside the inventory ratio chart is because it's a direct mirror, if you can't tell almost. Apple's cash conversion cycle definitely looks exactly like that flipped upside down. This to me indicates that they either have a very strong sales team or they have an insufficient inventory, or they could have both. You never know. Microsoft has a consistent positive linear relationship moving up, as they always do. They're moving up slowly and increasing their inventory turnover. I think they're doing it right as well right there. Next, we have our leverage ratios. So I'm going to start out with the debt to assets ratios. So both Apple and Microsoft are in good standing with their debt to assets ratios, as they're both below 1, which with Microsoft being slightly lower than Apple, Microsoft does look more liquid when it comes to debt being compared to their assets though. Definitely as the industry standard, you want to have less than 1. So obviously they're both in good standing right there. Next, we're going to do the debt to equity ratio. So Apple is not doing so well here with their debt to equity ratio, as they are well above the industry average with a 4-year moving average of 4.2. Earlier, we did see, however, though, that their return on equity, the net income over shareholders' equity, was also very high. This means, since both ratios are high, that they need financing in order to meet their business obligations, but that they are dependable and they are reputable and they can meet their business obligations with that financing. Definitely. Microsoft has a safe 4-year moving average of just below 1.5. The next leverage ratio is going to be our debt coverage ratio, also known as our debt servicing ratio. So this ratio, the industry average for the information technology sector, is going to be between 30 and 60. So Apple's debt coverage ratio is very high, but this makes sense because they've already proven to be using massive amounts of financing through their debt to equity and return on equities ratios. We know the story now, as we didn't in the beginning, but now we do. Their net income exceeds their debt obligations within the industry average, indicating that they are healthy. Microsoft doesn't finance as much as Apple, however, so they have debt coverage that consistently continues to rise. So they're able to cover their debt obligations better year after year. So the next ratio I'd like to go over is a valuation ratio called the earnings per share ratio. I only did one valuation ratio. Obviously, when you have more knowledge, it's better, but I did one valuation ratio because I used the trend analysis to identify the rest. So the earnings per share ratio for both Microsoft and Apple are relatively the same. Microsoft has shown a consistent year over year per usual of earning more and more net profit per share, while Apple hasn't been as consistent, but is still able to stay competitive by having a drastic increase one year and a slight increase every other year. They both fall under what investors like to see in stock performance at 25% growth year over year. However, they are only 1 to 2% away from the industry average. So obviously, Apple had a giant increase here, but they only went up 9% here in 2022 and 10% in 2019. As always, Microsoft is staying consistent, 21%, 39%, 15%, and they got 1% away from each other with their moving averages. All right, so on to the trend analysis. So I did a trend analysis on all the financial statements, but the only ones I wanted to show here were the income statements because I thought that they were the only ones that were relative to what is happening in terms of having an outside look at investing into a company, since we just went over a financial ratio analysis at the meat and guts of a company. So looking at this financial income statement, this trend analysis shows a lot of stuff. From 2018 to 2022, it looks like Microsoft's gross profit has grown 88% with a moving average of 50%, while Apple has grown 68% with a moving average of 29%. Microsoft has grown 83% in total revenue, while Apple has grown 47% since 2018. So that's pretty interesting. Microsoft has a moving average of 38% for research and development, while Apple has a moving average of 46% since 2018. I'm sure Microsoft and Apple will be using their research and development to come out with new products. Hopefully Apple uses it to figure out a way to lower how much debt they have or they're using for increasing their inventory. Furthermore, Microsoft has had a 339% growth in their net income since 2018 with a moving average of 228%. Apple has had a moving average of 29% growth for net income and 68% growth since 2018. So it's very clear what's going on here and who is potentially better. As you guessed, in conclusion, Apple is a great technology company that does prove to be a worthy competitor against Microsoft. We all use their phones. We all use their laptops. We love Apple. But statistically speaking, Microsoft is an overall healthier company. Since Microsoft has proven not only to be a healthy, functioning organization, but also a wise investment choice based off of sole progress they have made in the past 4 years, I would choose to invest $1 million into Microsoft because I'm confident they will keep growing, which means my long-term investment will also grow. So I would like to thank you guys for listening. I would also like to thank everybody at Savvy Coders, all of my instructors, all the TAs. I would like to thank Barbie and Lori and Jonathan for setting up everything. And that is all. I hope that you have a wonderful day, and I hope that you enjoyed my time, and I hope that you enjoyed your time. Thanks.